So good morning, everyone, and thank you for the kind introduction. I think we have a task at hand, and it was the bullet was the future of corporate banking. Maybe that's asking too much, but what we want to investigate in the next hour is actually what is the role of corporate banking, what is the role of transaction banking, global transaction banking going to be in the relationship between the corporates and the banks. And we all know that this is a give and take. And we all know it's only going to be constructive and it's only going to be good if both work hands in hands. There's a fundamental understanding of the individual needs of both sides and that the economics work out for both sides as well. Now, my name is Axel Miller. I'm a partner at Otto Wyman. I'm a consultant. And so the preconceptions of consultants always, we're academic, we are theoretic, and we don't have a clue about what is really going on in the industry. I've been fighting that for long. Today I want to use it and start with a quick intro on a more academic basis and putting out some hypotheses that hopefully will spur a discussion. So when I think about transaction banking and the role of transaction banking in corporate banking, I would say what we're going to see is that transaction banking is going to define corporate banking of the future. And why is that? And what is it when I talk about corporate banking or transaction banking? When I talk about corporate banking, it's the notion of providing credit, providing lending facilities through a relationship manager. That normally is the key interface to the corporate on a strategic level that should take care of all the needs of the corporates and bring in the other product areas. When I talk transaction banking, global transaction banking, what is that? That is normally the product set covering payment and cash management, covering trade finance, covering receivables finance. And global transaction banking, as we have seen it, has been on a journey for the last decade, and actually it moved in many institutions from a cost-focused operation center towards a business in its own right that now plays on eye level with derivatives, with lending, with other businesses. However, we believe there are a couple of trends on the supply as well as the demand side that going to move transaction banking even more at the heart of the corporate bank relationship. Let me outline some of that. There's on the demand side, we think the corporate clients' focus on working capital optimization, on cash and working capital management has increased dramatically. So the focus is very much on how to optimize that. That's core transaction banking product set. And what is needed now is basically what's been requested over the past years to increase the ability of corporates to manage their working capital much more tightly and ensure liquidity at all times. Corporates are integrating transaction banking functions and centralizing, for example, payment hubs. So the relationship between banks and corporates is being centralized here. The role of treasurers has become much more strategic, and whereas in the past often it was focused on liquidity and payments on the one hand, and then the CFO spare long-term funding, that has been integrated, and there's a lot to say of the corporate treasurer and the integrated liquidity and funding function here. So in that trend, there's a more integrated need to look across financing as well as liquidity management. There's an increased need to provide the corporate treasurer with more sophisticated solutions and support in managing these challenges. Now, if we turn briefly to the supply side, to the bank side, and we think that side is under much more pressure. Regulation and the market environment is actually driving a multi-factor resource optimization problem. That means for corporate banks, it's not only about capital, it's not only about risk-weighted assets anymore, but it's about managing liquidity, it's managing capital, it's managing leverage, it's managing balance sheet capacity. All of that in a situation where demands for these resources are ever increasing. What that means, from our perspective, is that banks' lending capacity will become more restricted. And so we might, this is not the case today, but going forward we might see basically shortages in lending supply by banks. What is going to happen is institutional investors are already standing out there and going to step in. Finally, I think banks have realized in the past couple of years that product profitability has changed. The old mantra of I have a credit-led relationship, and all of you from the corporate side know that very well. There's cheap credit, and then you pay the bank on the derivatives, for example, on the hedges. That game doesn't work anymore as the economics have changed for these products. So that has brought a different product set, namely the one of transaction banking, much more in the center of making sure that the overall relationship does work from an economic perspective. So if I put that together, what does it mean for me? It means that corporates are more and more optimizing working capital at the short end. Third-party investors are more and more focusing on bringing in capital at the long end. And what is the role of banks? The role of banks used to be to provide financing and transactions and transaction processing in the first place. I think that's going to change. What is left is banks will play a role as intermediaries in the sense of it, intermediating between different demands on the corporate side and different suppliers. And what does that require? That actually requires managing information, managing flows, managing infrastructure. Very much to Paul's point about banks will become more and more infrastructure providers. And that, for me, moves the whole transaction banking product set at the heart of the bank-corporate relationship. Meaning, you got a current account, you have payments, and that defines the relationship. The bank needs to manage the data, needs to analyze the data and understand what the needs are, what the dynamics are in that. They need to help the corporates manage working capital. They need to help channel third-party money into that. So that means actually putting to the extreme the old model of credit-led corporate banking is that, newly the model of corporate transaction banking. And with that starting hypothesis, I'd like to introduce my panel today of esteemed corporate and transaction banking expert. I get Susan Skerritt, head of Global Transaction Banking Americas, Deutsche Bank. George Nast. George runs George is the global head of product management, transaction banking for Standard Chartered Bank. Ranjana Clark, head of transaction banking Americas, Bank of Tokyo, Mitsubishi. I've got Carlos Gutierrez Salan. He heads transaction banking for the Americas region for Banco Santander, and Pascal global head of transaction services and payments solutions for Société Générale Group. Turning to you, I described kind of story of transaction banking, corporate banking. Do you think I'm completely stupid? Do you think I'm completely nuts? Can you see where I'm getting at, given your experiences in industry? Susan.
Axel, there's a wonderful Chinese proverb, may you live in interesting times. And I think it's fair to say that we have all been living in interesting times for the last 5 years. Clearly, there has been a shift. Let me start with the shift in the banking industry. In the banking industry, transaction banking is an extremely important component of what banks offer. At Deutsche Bank, it's one of 4 pillars of the bank. Clearly, given the low utilization of capital, the annuity revenue stream, it is a very desirable set of services for banks to offer. And let me look at it from a corporate perspective. Corporations, corporate treasurers face a situation where, while there is excess liquidity globally, much of the cash is not at their disposal in their home markets. Certainly for U.S. multinationals, cash is trapped offshore. There is also, I believe, some question, given the credit crisis, about over-reliance on the capital markets. As a result of those things, corporate treasurers are focused on working capital management, perhaps to a greater degree, and we believe are more fully integrated across the whole supply chain of their organizations. We see corporate treasurers working more closely with procurement, with the business areas, and getting involved in more questions around distributors and suppliers. So with that as a background, let me respond to your specific question. I certainly think that working capital management becomes more front and center for corporate treasurers, but I don't believe that it will supplant the requirements for credit.
Thank you. Pascal, Suzanne just talked about the over-reliance on capital markets, and I think from a European perspective, that's probably a different perspective on that. How do you see it?
Slightly different. I also wanted to draw from my own experience on that. Very same day, 3 years ago, I moved from the wonderful life of investment banker to corporate to transaction banking, which is always a good sign. But back to Susan's point, I think we European banks have been always operating a universal banking model. That means that we never forgot that our role was to support the real economy. So what we had to adapt was to adapt to the client needs, and basically in a European market, which was essentially with a low growth. Our clients, our treasurers, our CFOs needed to pay much more attention to the management of their working capital, the management of their liquidity. Just for you to have in mind, we all faced in 2011 a huge US dollar liquidity crunch in Europe, so we had to see where the pools of liquidity were, and that's where our top management realized that those transaction banking businesses were businesses worth investing because of liquidity providers, because they were businesses that were leading to a good growth rate. We operate on a worldwide basis, and the cash management, the trade, the working capital management services, they provide roughly between 5 and 10% growth per annum, which is immense compared to the average growth in European economies. So that's very important for us. That's very important for clients. People also tended to realize, as you rightly said, Axel, that it was top of the agenda for our clients going forward. And essentially, it moved up the ladder. I have one very good example. 3 years ago, our top managers only spoke about IMF meetings, bank-to-bank meetings. Now they care about what we're doing here at Cybers. They want to hear what the trends are. They want to hear what the expectations of the clients are. And that's totally different from 4 years ago.
George, do you want to go next?
Sure. I agree about the shift in importance in transaction banking. And a little anecdote is it used to be perceived as a very unglamorous business. And a few years ago within Standard Chartered, we tried to dub TB, transaction banking, as sexy. I'm not sure we've quite gotten that far on rebranding the business, but I think the importance of it has definitively increased. And I think there's really 3 drivers of that. I think, first of all, the business fundamentally is about supporting the operating activity of our clients. That gives us enormous insights around what's going on with the client. And I'm going to come to the point about credit in a second. In my view, you can't actually decouple that. We take a risk view on this and saying, if we're going to have a credit relationship with the client, we actually want to get into the operating activities of that client. That helps manage and mitigate the risks in a substantial way. I think the second thing is that the regulatory environment has shifted, I would say in many respects, very much in favor of the transaction banking business. It generates a source of very stable, sticky relationships and actually longer-term sources of funding if we do it right. It also generates a great low-risk, short-term set of assets that bank balance sheets can invest in. So it's become much, much more core to the overall balance sheet and the operation of a bank. I would say also it's a business that's become much more innovative. Paul talked about it in the introduction. We see it in our footprint in the emergence of mobile payments, not just as a unique tech phenomenon, but in the fact that it enables a huge population of under and unbanked people to access financial services. It delivers financing, for example, farmers in Africa, SMEs in South Asia. So it's been a big source of innovation as well. But to the point about, does a credit-led model change? As I said, in my part of the world, Asia, Africa, Middle East, it's hard to decouple that. What we do instead, though, is use transaction banking as an important risk mitigant to enable both businesses to operate together.
Thank you for that. You were talking about, George, about the sexiness of transaction banking. Now, Ranjana, you've come from an industry that is deemed more sexy than transaction banking. With that in mind, how do you see the role of transaction banking having evolved?
So I think what Axel's referring to is I most recently came here from, I guess, now infamous or famous PayPal. So, just having left this industry for whatever, 5-ish years or so, I think that there are, I'd say, probably sort of 3 changes that I see. And I do see that, firstly, I see this business as having become a lot more sexier than sort of the old cash management business. And I'd say that's probably for 2 reasons. One, the returns that have already been spoken about. And secondly, I think this business is a technology-enabled business, and technology has moved front and center with the advent of the smartphone or the mobile device. I think everybody, consumers use it. We as consumers use it in our lives. And we expect to use it in our business as well. So I think the fact that it's become more technologically enabled has caused it to be of greater interest. So that's sort of one. I do think it's become sexier. I think the second thing that I've seen since I've come back is a greater focus on what I'd call sort of customer needs, customer experience, solving, consumer pain points. The best technology companies really start by focusing on solving a unique consumer pain point or solving it in a better way. Certainly, again, witness the iPhone. There was nothing new about, glass and wires and chips and whatever. It was, all of it is commoditized, but it's really the experience that's unique. So I think our businesses, our payments businesses oftentimes have been called as commoditized businesses. I think the experience is what makes each of us unique. And I think that whenever you talk to a customer, whether that's a consumer or certainly a corporate now, they really say 3 things, They say, save me time and hassle, save me money, and keep me secure. That's pretty much what the consumer companies like PayPal are focused on in creating a digital wallet. What we in transaction banking do is pretty much run a digital wallet where we have all forms of receivables and we make those payable. So I see a lot more focus on the experience, on making things simpler for our clients and keeping them secure. And the third thing, again, big change that I've noticed since I've come back is a huge focus on, I'd say compliance and security. So I think if you put those things together, would I say that the transaction banker has become, is about to supplant it? I'd say no, but I'd say if it was a 3-legged stool, or at least in most of the institutions where I've been in, it's been corporate banking, investment banking and capital markets, and transaction banking. I think we were by far the shortest leg before, and I think now we've become, a much more equal partner with the other 2.
Thank you. Carlos, we were talking about infrastructure, and given that Grupo Santander is active in countries where basic infrastructure for lending hasn't been there, I think the role of technology-led receivables finance programs, etc., have played a much greater role in some parts of Latin America, for example. Hence, I think it's the developed countries that can learn from these experiences in moving up the ladder on the technology side. How do you see that panning out across
right.
the markets?
I think, basically I agree with most of the things that you've been saying. Probably the only one in which I don't tend to agree with you, and seems to be that we are more or less aligned here, is that looking forward into a model in which lending is not going to be part or the centric part of the relationship with the corporate, I think that's still far away. I agree that disintermediation is happening. I agree that that's going, fast, especially on developed countries, not so much on emerging markets, but still, whenever you discuss and you get into relationship with your customers, still the case in which you're discussing what's the tier you want to be there, what's the level of capital you want to deploy to that particular customer so that you can access the right wallet, and transaction banking is part of that. So yes to the changes in the working capital scene, on the operational efficiencies, but not so much agree on the fact that lending is going to be moved away from the discussions. Now, in terms of the changes that you were referring to Latin America, it's true that Latin America is still far away in terms of infrastructures, and SWIFT is probably one of the examples. SWIFT is very much becoming a standard for the market in developed countries. It's not that the case yet in Latin America, and this is something we've been discussing with SWIFT many times. That's something where we both, SWIFT and the banks, have to work on to move forward. What I do see, and that's both in developed countries and emerging markets, is that the companies are moving and are changing to look towards more or to get more operational efficiencies in the way they process transactional flows. So you see big multinationals more and more engaging into these shared service centers with centralization of payments, payment hubs. And for that, the change that I'm seeing in the last 5 years compared to what happened before the crisis is probably that first, they are not looking for a single provider globally, so they are trying to split the processes or the RFPs into regions, so to be able to have a sort of backup and contingencies within the different banks. So that's one thing. And the other aspect, which is also part of the same discussion, is standardization. And SWIFT is becoming probably the market standard for that. And again, because customers are looking for flexibility, they don't want to get engaged with a single provider. They want to be in a position in which if something happened with that bank, they can switch easily to another provider. And the other change that I also share with the rest of the panels here is that the working capital is becoming center of the plate. Probably again, if you look at it 5 years ago, 7 years ago, companies were more looking at simple stuff like receivable discounting, more from a risk management point of view rather than working capital efficiency. However, now they are looking at the supply chain on a more holistic way, if you want. And we are seeing more and more of these payable discounting programs coming into place. This is becoming a massive explosion, I think, in the market. More moving from the emerging markets from the developed markets into emerging markets, and probably started a little bit earlier in Europe with the probably more favorable interpretation under IFRS than US GAAP on the accounting treatment. Having said that, I think that going forward, it is going to be critical to see how we can integrate those supply chain finance solutions into the massive payment hubs that we were talking about before.
Thank you. So, listening to all of you, you got me closely to basically refusing on my initial hypothesis. But before I do so, I wanted to ask you. So, in order to make this discussion relevant, we got a couple of questions for you. And please take this BlackBerry type devices, and I would ask you to vote. What you need to do is you need to push the number that's going to come up on the screen. If you change your mind, press the red triangle. And input the new choice. And for those questions, there will be one multiple choice question. There's more than one answer that you can give. Please enter each individual number and then press the green button to submit. So, all set? Let's go. So first of all, we would get a better understanding of where you guys come from and what are your interests. So if you are a banker, please press 1. If you are representing a corporate, press 2. If you cannot decide, press 3. Very nice. So, thank you. That was an easy one to warm up. Now, for the 22% of corporate representatives, I got a question for you, and that's now only for you. The rest will be able to vote afterwards, and the others, I'm sorry, only at the last question. So, could we have the next question, which is very much about how you see the role of lending versus transaction banking, if you would accentuate playing out. So how many of you would be willing actually to move to a transaction banking, payment-led relationship and reduce the importance of credit, i.e. not making credit the prerequisite for allocating GDP business to a bank? Just to put that different words, normally the bank knocks on the door and it's a cold call. You would rather say, in my experience, okay, you're giving credit, giving you an overdraft line, and then we're going to see what we're going to do if you're still there in 3 years down the line. Do you think that is going to changing. Would you be willing to make that change? If so, please press 1. If you say no, it's a prerequisite that we enter discussions, press 2. Wow.
Wow. Wow.
Thank you for that. It's support. I'm surprised, but that gives us great food for thought for the further discussion. So that's super. Now, moving to the banks, and I got a question for the bankers amongst you. So, when you think about moving transaction banking into a more central role, to the relationship anchor, we need to think about what capabilities are required. And transaction banking has been on a journey. As was said earlier, it has been somewhere in the operations center and has moved up to being equal-sized and equal positioning as capital markets and corporate banking. What are the capabilities that are required from your perspective to move it even further and put it at the center of the corporate or the commercial banking proposition that banks can offer to clients? And that's a multiple choice question. So you could click on more than one. Please remember, press the number, then press the green button, enter the next number, press the green button, and here we go. All right. That's very interesting. The strategic positioning being the key driver here, indeed, and that's, I think, part of that journey that we've been discussing further, and that will give us a lot of food for thought for the coming 30 minutes or so. I'm quite surprised to see also that people skills are not rated higher. My experience, this has been one of the key challenges, but we're going to come to that in a second. Final question to all of you. It seems like you're pretty optimistic that the direction that I outlined at the beginning might be the one that we're going to actually see. Do you really think, and that's the question for all of you, do you really think corporate transaction banking model will be feasible or will be realistic in the foreseeable future? You think 3 years down the line? Press yes if you are. Press no, you think the challenges are too big to be overcome. Super. No. Well, thank you very much. I think for all of us, that's very good food for thought. Now, taking these results back to the panel and drilling into some of the more of the details, what do you think, if we put ourselves 3 years further down the line, what is going to need to happen in order to put this into practice? How is the relationship between corporates and banks and transaction banks going to change? And I think in the next couple of minutes we should focus on dividing up the segments a little bit, and also maybe differentiating the regions a little bit, because we have a fantastic representation across the region here. Let's get started with George, because I think you have a good view on the SME sector on the one hand, on the Asian and African region on the other hand.
So the results are just fascinating. I want just comment on the importance of the strategic positioning. It actually worries me a little to see, because that's actually a very internal view, right? At the end of the day, our clients don't really care about that. They care about ensuring that we deliver our value and deliver on a service. So it's something as banks, I would urge us to really resolve the internal challenge and get on with serving our clients. I think if I look forward for over the next 3 years, I do really see a barbelling of the client base, particularly within the emerging markets region. You are seeing transaction banks still have a fairly homogeneous service across the client segments, and that is really beginning to change. There is the budding middle market SME segment that's an incredibly important driver of economic activity, particularly in Asia, but also increasingly in places like Africa. And there we've really got to figure out as banks and financial institutions how to create a more standardized, lower cost model, yet still at the same time delivering on the needs of those clients as they expand their business and as they go increasingly cross-border. At the other end of the spectrum, increasingly you are seeing multinationals from Asia of size, breadth, and scale that already rivals a lot of Western multinationals. And they really have an advantage where it took several years for Western multinationals to build their treasury centers or their shared service centers. These companies, particularly from Asia, want to leapfrog that and compress the time frames substantially. And they're looking at banking partners to be able to deliver on that. So what that means for transaction banks is, again, we've got to really think of how we barbell our proposition. Be able to deliver a very advisory-focused, high-touch type of model to those large clients who really want to rapidly accelerate the consolidation of their treasuries, the creation of their shared service centers. But at the same time, ensure that we've got a highly scalable, standardized infrastructure so that we can also serve the vast breadth of middle and smaller companies that are also emerging from the region. That's a particular challenge, and it does require a real flexibility, I would say, in the underlying infrastructure of financial institutions, but layering on top of that a very high-skilled, capable, high-touch service to address the multinational side.
You know, it's interesting, George. I actually have a very different view on the first point that you made about strategic positioning. Clearly, we all need to be client-centric and focused on our clients, but the reality is that where the transaction bank fits within the organization drives the level of emphasis, the level of investment, and the ability to actually deliver capabilities to our clients. So I think it actually is very important. If you, those of you in the audience that are corporate treasurers, if you are not looking at where the transaction bank fits within your bank and not convinced that that's an area of priority, then you may not see the kind of investment that's required to ensure the right infrastructure, the right capabilities, and also the right attention to cybersecurity that Paul talked about.
Yeah.
Can I add to that? So, you know, I've been known to say it before and I'll say it again. Our clients really don't care about our products at all. They really care about what our products can do for them. You know, it's about their company, it's about making them more efficient, it's about serving their client needs and enabling them to scale, to go global, whatever it is. So, you know, I think in addition to the points that have been said, I think what I would add is that, you know, human capital is exceptionally important in this business, and I think that, you know, whether transaction bankers will become preeminent or not is very much dependent upon the strategic dialogue that that banker, whether you call them a transaction banker or a corporate transaction banker, can drive with their client. Do they understand their client needs? You know, understanding not just the working capital cycle, but really the capital structure and being able to work in an advisory manner with the client becomes really important. And so to the extent that it's the investment banker or the corporate banker that is having that conversation with the CFO or the CEO, you know, I think then they're going to, you know, stay in the mix. I'd say that, you know, the transaction banker will always add something more unique because we are dealing at a higher level of integration with capabilities that are flow-based, whereas typical corporate bankers and investment bankers have episodic conversations. So there's a once in a while, financing event, whether it's a loan or a capital markets transaction, an IPO or a capital raise, whereas our products are very integrated with our clients and are used day in and day out. If we sneeze, they get a cold. So, I think that our products and our bankers are seen as very vital in a holistic relationship with clients because, it's about stickiness, but it's really about that continued dialogue. There is another reason to have a conversation, to add value. Where are you growing? Where are your pain points? If you're going global, are we there to support you in those regions?
Axel, I will help you build the consensus because I think I can't but agree with all three of you. Because back to Susan's point, I think it's highly important to know where transaction banking is positioned, just to get the right support and resources. Because as we all know, we are operating in businesses which are highly technology driven, which are flow business, so we need factories that are fully operating with a low level of cost. So it's highly important to get the support from the top management to get that building up, especially at a time where, say, expectations move up towards the real-time digitalization and so on. So we need investments. So the way it's positioned, has its importance also to attract the right profiles. And back to your point, Axel, I was surprised also to see people skills ranked so low, because for me that's very important to attract the right skills. And that's what has changed over the last 3 years. Bright people come our way. They are not just lured by M&A and the rest. They think there is value in our businesses. That's for one. So I agree with Susan. Second, as I share with George, say a similar approach, which is that, as far as I'm concerned, I'm operating in 75 countries. So it has to be a multifaceted approach anyway. There is no one-size-fits-all transaction banking approach. When I'm speaking to Western European or US clients, and when I'm speaking to African clients, the level of service is definitely not the same. So we need to be able to play on the different layers. We need to be highly sophisticated, highly technology-driven when we are speaking to multinationals, and hence we have been very eager to push, for example, Swift product suite, because we think that mirror the needs of the client. And at the same time, we need to be back to basics when we are addressing the need of an SME in an African country. So that's the difficulty and that's the challenge we are facing, to be able to play on all registers. And back to your point, Ranjana, I think I always share that vision that a good banker, call it a corporate banker, call it an investment banker, is a banker who cares about the holistic needs of a client. So I always opposing the models, a lending-based banker, an investment banker, a banker who really cares about his clients. He needs to be aware and he needs to take care of all the dimensions the client wants to address. And that changes over time. So depending on the cycle in which the corporate is, whether it's in an investment phase, whether in a cost efficiency phase, we need to accompany those needs. And that varies over time. And whatever the size of the company. The more we are addressing an SME, the more we need to capture everything, because generally we've got one or two guys in front of us, and then the more it goes, the more sophisticated it goes.
If I can add my 2 cents on this, and I agree that transaction banking is clearly the type of product in which you create that rapport and that day-to-day contact with the customer, so you get into the core of the relationship. But I want also to link this with the fact or the question you were making about lending and the fact that lending is the core center of the relationship or not. And I think that transaction banking is clearly the kind of product that the bank needs to really make the return on capital that they need. And that's important when you get into the discussions with the corporates, because it's true that we have to find the ways of serving the customers in what they need, but also we need to get into those discussions in which both the customer and the bank can find the common ground in which the capital deployed to that particular relationship will be paid and will be getting the return that the bank is needing, especially nowadays with the change of regulations. Probably this was not the case, or this was not so much the case a few years ago. Now it's becoming more and more the case. So banks are trying to find that way of maybe changing the way they lend, maybe getting into more uncommitted versus committed, maybe getting more into working capital solutions versus pure plain vanilla lending. But at the end of the day, it's a common discussion between the bank and the customer. So yes, I agree that transaction banking is going to become more and more the center of the plate, both because of the fact that they get the sticky business and it gets the relationship, the core relationship with the customer, and also because it will be the great business for the return on capital that the banks are required nowadays.
I've taken out two key areas in that discussion. One was the kind of what is the self-understanding, how is the positioning of the transaction banker versus the corporate banker. And I was wondering, I had the question down there early on, right? What is the self-understanding? I think we are still on the journey for the transaction banker to define him or herself more in terms of an advisor rather than a servicer. Only then I think he can make use of the flow of information. Would you agree with that?
We're both. We have to be both. We have to understand what it is clients need. We have to understand the requirements. We have to be a trusted advisor to really be able to shape a response. But then we are transaction servicers. So it is also necessary that we deliver the service. One of the things that we're doing at Deutsche Bank, because we focus on multinational corporations, we are treating our products like a Lego set, where we are thinking about the individual product components and putting them together in different ways to meet our clients' needs. And that really is essential because, to George's point, there have to be economies of scale in this business. So what we're trying to do is to achieve economies of scale while meeting the specific needs, developing solutions for specific clients. But we have to be both.
Yeah, I agree with that. I think there's an advisory piece which helps come with unique solutions very tailored on the specific need of the client. Then after that gets implemented, it has to work.
Yeah.
Right? Because if it doesn't work, then all that advisory work is for naught and the client has lost confidence in you as an institution. And therefore, you really have to be good at both in order to succeed.
I think as an institution, we have to do both, be an advisor and a servicer, but I don't think the same person has to do both in equal dimension. And I think most of us are sort of taking our treasury or transaction banking relationship managers and moving them up the advisory curve and still trying to make sure that there's, either self-serve capabilities that, clients want to use now because they don't have the time and they don't want to pick up the phone, or that they have somebody at the financial institution who can help them. But I don't know that it's necessarily within, sort of the same person.
Mm-hmm. And it's not just about the bankers anyway, because as we are operating on huge flows, it's about the bankers, it's about the IT guys being able to talk to the IT guys, the companies, it's about back office people being able to do post-sale service. I think it's the interesting thing with that job is that it's not just done when you have sold the product.
Yeah, and now
Yes,
so much
and
more increasingly we're using partners, vendors.
Exactly.
I assume that, the other that was in the chart
31st, yeah.
are, a lot of technology companies, a lot of vendors, a lot of partners who really are vital in completing that value chain.
Exactly.
This is a very interesting point, because the second element that I wanted to draw upon is infrastructure, the role of technology and infrastructure here. I think you touched on it. And if we follow that logic that we discussed, that you put the current account, the payment flow into the center of the relationship, and then you use that in order to start the dialogue or in order to keep the dialogue, and you get the information from that. It requires a lot of technology, it requires a lot of infrastructure in order to be able to analyze the flows, in order to detect the signals, in order to get the risk triggers and all of that. Do you think banks are already there, that they can leverage that wealth of information, actually, based on that, build a focused advisory model? Second question I want to put in, do you think banks can keep up with the technological pace that is around there that we discussed in order to get there? Or is there only a way about partnership solutions that you just mentioned? Carlos?
Well, yeah, I think that's a critical point going forward. First of all, how you're gonna take all these investments, and second, how much, and you're going to be able to put in your budgets for that. I think that the critical point here is that the gap between large banks and medium, small-sized banks is going to widen in the next few years, and it's going to widen in a way that will make really difficult for medium-sized institutions to truly be able to catch and be part of the game. Especially if what the voting and you are saying is going to be the case, and lending is not going to be so much the center of the plate. The other question is whether you want to go for your in-house development or you want to use external vendors for that. And what I see in the market is that nobody is able to really make all these huge in-house investments, not only because they don't have the money to do it, probably they have the budgets and the money to spend, but they don't have the internal resources to accomplish those investments internally. So the use of external vendors is becoming more and more, in my opinion, the case for most of the banks, if we want to deploy the solutions with the time to market that customers are requiring.
And I would say that the way the audience is broken down is very interesting. It mirrors the way we are addressing business. So almost a quarter of corporates, 1/3 of banks, some external providers. That's the way we do. We cross-develop, we join develop with clients, we join develop with IT providers. We have that mixed together. I have one good example. We are operating a lot with e-commerce clients. With e-commerce clients, we are redeveloping the business model together with them. It's not just us bankers acting as providers. It's also defining the way their business model should be plugged to the banking system.
I probably have a more bearish view, just having more recently come from the technology business. I don't think we are good at technology development. I think we have to partner. I think our development cycles are just, way too onerous, long, and so on. Secondly, I don't think we deploy big data or advanced analytics well enough. I think that our information is very dispersed. And as an industry, I think we've talked a big game for a long time about information-based advisory solutions, predictive analytics, and so on. I think we're still not even 10% into the game, and I think there's a lot more to come there.
Although we are trading a fine line, because I think a lot of the trust that the clients are putting on us in due to the confidentiality with which we treat their data. So there is a way to address big data, and there is a lot to be done, and we are far from here, and to be very sensitive as to the way we handle the data.
Privacy.
Because that's part of the
And I think it's absolutely crucial that we are all focused and really understand what are our target areas, where can we be strong, how can we support our key clients. I think it's equally important for corporate treasurers to be focused. Which banking institutions are going to enable them to succeed? Paul talked about having contingencies. I think the reality is, given regulatory dynamics, given changes in the banking industry, there's no question that Axel is right. There are probably going to be fewer banks that are going to be able to meet the array of credit needs across the corporate environment. So it is absolutely essential that banks focus and be very thoughtful about where they are targeting themselves and their capabilities, and that corporate treasurers are very, very focused on which banks are focused on what they need and meeting their requirements.
Which leads us to another dimension, Susan. I think you're just, say, less than a quarter of corporates in the room, but the importance of such Cybers meetings for us banks is that it's also a way for us to partner together, because more and more what we're trying to do is not just compete with each other, but trying to develop solutions that address your needs by combining our strengths, by combining our technologies, by combining our approaches also with IT providers. And that's one of the merits of those gatherings.
Pascal, let's use that and say kickstart the dialogue. I would open the panel up or the audience up to raise questions, and I would encourage you to throw it out at us. We got 10 minutes or so more to go. So, who wants to come up with questions? Oh, there's one over there. Marcus.
Thank you. Question for the panel. If SWIFT could do one more thing that it's not doing today to help you succeed in the topics you're describing, what would that be?
If I have a request, I think my request would be to be much more present in Latin America. We need to work much more in Latin America, and this is because probably that's our core region, but I guess that's also the same case in other emerging markets. I think that's something where SWIFT needs really to push up. Yeah.
And I would add another geography. I think it's highly crucial that you continue to push in Asia, because that's where our clients are investing, and that's where we need to have as good a setup as in Europe and the US.
So I would say is all of the good work that's being done in correspondent banking related to compliance, KYC registry, etc., extend that to corporates.
Yeah, that's the point.
Uh-huh.
Yeah.
Two things, Marcus. I think that we've talked about cybersecurity. Clearly, SWIFT needs to be very, very focused on that, and I think you already are, but I would encourage you to continue that focus. It's absolutely essential. And the second thing is, I think, to continue to have these types of corporate forums so that there is a dialogue between corporations and banks with SWIFT as the kind of underlying platform. I think it's incredibly valuable.
I wouldn't add anything. I'd say get all these things done.
Yeah.
I mean, now the wish list is open, so if any one of you has something to add. Other questions, comments? There's one over there.
I have a very interesting question, actually, and one of those that resonated with some of the comments on the panel. There seems to be some institutional angst surrounding developing a common standard. The organization continues to offer up, whether it's an XML or some other product that can help standardize a payment initiative. But for some reason, when I go to the same bank and make payments in country A versus country B, there's still differences between what's required to settle those payments. And actually, it's not always regulatory in nature. It's actually simply a bank office issue. And we talk about innovation. Innovation tends to fall upon a bank portal and the different colors that you see when you first log in. There's no real back office innovation, which is critical for us as global corporates to make and standardize our payment initiatives.
I think you are absolutely right. The technology architecture is fundamental in terms of what we're offering in transaction banking. And that, if I might for a moment, I mean, that's something that Deutsche Bank is very focused on, ensuring that we have consistent architecture in all of the global markets in which we operate. Now, having said that, because banks, and many of the banks here, and we have been operating in so many markets for so many years, it does take time in some cases to ensure that we have that consistency, but I can assure you that is absolutely crucial to enable us to effectively deliver to our global corporate clients. And I would encourage you, as you're talking with your banks, to ask, what are they doing around technology architecture, that fundamental question of enabling consistency across the globe?
As you know, there has been a quantum leap already this year with the implementation of SEPA across Europe, which has helped us immensely. And I think starting from there, what we are already seeing is that drawing from that, say, transfer and move to XML, that will accelerate the process, at least across Europe. We see all Central Europe moving that way as well, so that will spread across. And for us Europeans, that has been a very important step because of, that have got us rid of the old systems. Yeah. For such a vast project, we are just 2 months down the road after the official implementation, so there are still some things to rule. Right. Yes.
I think the biggest challenge is in the corporate space is just so heterogeneous. I mean, my bank operates in 70 markets, and it's not just, and I agree with you, it's not just regulation that's driving it, it's just the practices among corporates. So I don't know if you represent a particular corporate, but it'll be different from what we face, what a corporate need will be in a different market. And in the process of catering for all, sometimes banks are unable to cater for any, at least in a really efficient way. It's a constant struggle that we have in our back office, in our systems, and our technology. So one of the things that I like about the SWIFT initiatives, at least, is coming with an increasingly set of standards that we can all work towards to ensure that the challenges that you raise can be addressed.
You know, the only thing I'd add is maybe a couple things. One, you know, I do believe behind a portal there is sort of a lot more technology than just, you know, colors and rounded edges. So, you know, there's a lot that goes behind that. And I do believe that a number of institutions have invested significantly from my observation. I think the second thing is that, you know, the reason that all markets don't look the same in terms of just, you know, look, feel, touch, experience, that's the architecture. That's sort of what we're driving towards. But I think that a lot of these businesses were sort of entrepreneurial. They grew up in response to a specific customer need. There may have been a vertical or a certain regulation or a market need. And so, at least in our company, you know, we're in over 40 markets. The vast majority of them are in Asia. They sort of had a little bit of a different lineage, very entrepreneurial. And now we're saying, you know, can we put in an infrastructure top-down that scales globally, that enables, in particular, companies that operate in multiple geographies to have sort of a uniform look, touch, feel experience.
Yeah, it's, as a Frenchman, I would say it's mixing together Zara and French haute couture, which is the difficulty and the change and the change of the business.
I like that analogy.
Yeah.
Thank you. There was a question in the middle here.
My question is, in one hand, we are seeing that banks are really focused on improving cash management, payments, collection services for large corporations. But in the other hand, in the retail space, and mainly driven by the digitalization, the banks are trying to cope more unbanked people. So I want to understand if you are seeing this blurring between this kind of segmentation we are seeing between SMEs, retails, and large corporations, and the kind of value added that the banks are seeing to provide large corporations in order to have a more holistic view and help them serve their customers.
I don't know. I mean, I don't know what to say. Really, the segmentation you are talking about is clear, and I think we are going more and more into that. I think retail has nothing to do with the business on SMEs. SMEs has nothing to do with the large corporates, and sometimes large corporates are nothing to do with the big blue chips, big multinationals. So those segmentations are needed, and the resources deployed to each of those segments are totally different. Needs are different. I mean, we were discussing about huge investments in IT to be able to accommodate the differences that we have in each of the markets for big multinationals. So a big multinational is asking you how you can overcome the fact that in Brazil, 80% of the payments are made up by boletos, while in US are done by check, and then how you accomplish an online banking that will be able to substantiate everything into a single same similar process. If you go to retail, to SMEs, that's not the need. And probably in SMEs, you will have to get into different sort of discussions with the customers. Now, the question here for us sometimes it is, how can you make a better link between your big corporates and their customers? Because for us, it would be also a really easy win if we can get to intermediate the flows between those corporates, large corporates, and their retailers or retail customers or SME customers. And for that, I was referring at the beginning to these payable discounting programs and other ways of helping those suppliers that normally have a different creditworthiness than the large corporation to really discount those receivables or those payables. But other than that, I think that those kind of segmentations, they have to remain because the needs are totally different.
Yeah, you know, I have a very different perspective in my markets. I think actually financial inclusion is accelerating thanks to technology. I mean, in India, for example, the Prime Minister has this audacious goal to sign up something like 60, 70 million new unbanked accounts by the end of the year. In Kenya, there are now more M-Pesa mobile wallets than there are actual bank accounts within. And that sort of trend is going. We spoke to a technology vendor that has a vision to create a cloud-based banking model of $1 account a year. Right, so the thresholds for banking actually in some segments may actually be falling thanks to technology. I don't know if that's the case in developed markets, but that's what I'm seeing in emerging markets.
And again, as we said, the more we invest, we're in the flow activity anyway. So the more we upgrade the systems to get the pricing down under the pressure of the large multinationals, the better it is, because it filters down to the SMEs afterwards in terms of the cost of the service we can provide them. And then the challenge is to be able to adapt, not to have too sophisticated an approach for the SMEs, whilst say combining the two.
Okay, thank you very much. I fear we're running out of time. Actually, we're already over time. If there's one last question, we go for it.
Thanks. This is a question for Ranjana, and I would like to understand what you pointed out regarding who should be the person in the bank that try to understand the needs of the customers besides the IFRM. And you were referring to a specialist in product, or to who kind of person?
Well, I think it is really the responsibility of all client-facing sort of points of contact from a financial institution or a bank to understand client needs. I think it just depends on sort of who they are interacting with. And so, starting with maybe the corporate finance banker or the corporate banker, they are likely in touch with the CEO or the CFO who has, sort of a different view. It's more around, a strategic view of the company, capital structure, M&A, board, those kinds of conversations versus, somebody in customer service who's dealing with somebody in receivables or payables on a day-to-day basis. I think it is just as incumbent on the part of the customer service individual to understand client needs, but it's at a different level. And the transaction banker, the trade, specialist, I think we all have a role, but really looking at it from the client perspective in versus the bank perspective out.
Thank you very much. With that closing words, I'd like to thank you for all the attention, for being here and for providing us with very good food for thought. I think we have underestimated the willingness to change. Yeah. There's a lot to chew on. We're going to take it away and hopefully come back to you and continue the dialogue as we go. Thank you very much.
Thank you.